Gold and silver just entered the phase where the headline price is the least important number on your screen. Because while everyone's hypnotized by the spot chart and the next macro headline, the real fight is happening underneath, inside the plumbing, inside the carry, inside physical demand signals that don't care about anyone's opinion. And the reason this matters right now is simple. If one specific level breaks, the math changes, the hedging changes, and the next one to blink won't be retail. It'll be the desks that have been leaning on this move is overextended as a comfort blanket. Stay with me, because in a few minutes, I'm going to give you the exact checklist I'm watching for the next week, the levels that matter, and the one hidden detail the mainstream keeps missing that can flip the entire setup. Here's the snapshot. As it looks right now, gold has been hovering around the mid 4,400s after tagging fresh records, and silver is still printing in the high 70s after a run that's already rewritten a lot of people's risk models. That sounds like strong metals, fine, normal, bullish, but that's not the part that matters. The part that matters is what's happening when you step one layer closer to reality, where metal has to move, where financing has a cost, where inventory has a category, and where the market quietly reveals whether it's a clean rally or a stressed one. Because if this is a stressed rally, the price can do things that feel irrational right up until the moment you realize it's not sentiment pushing the market, it's forced behavior. And now let me give you the hidden detail right away, because it reframes everything. The physical signal is splitting by region in a way you don't get when this is just a chart rally. In recent pricing, China has been paying a big premium over spot, think roughly $20 an ounce over the global benchmark, while India, a traditionally massive consumer market, has shown softer premiums, closer to the mid-single digits. That is not a cute trivia fact. That's the market whispering, this isn't one unified demand story. It's a tug of war between strategic, policy-shaped demand on one side and price-sensitive consumption on the other. And that split matters because it tells you who is setting the marginal bid right now and who is stepping back. And when the marginal bid shifts, the whole structure shifts. And that's where the real pressure starts. Because if you only watch spot, you miss the most important question: who needs the metal and who just wants exposure? Exposure can be sold in a second. Metal demand has lead times, logistics, and procurement constraints. And the moment you get a spread between paper price and physical urgency, the market starts doing something strange. It begins to punish anyone who assumes time is free. That's the key. Time is not free. Storage is not free. Financing is not free. Delivery is not free. And when the market starts charging you for time more aggressively, or when it starts paying you to give up time, that's the market telling you something about stress. So let's talk about the boring mechanics that become everything when metals shift fast: the cost of carry and the term structure. Most of the time, gold trades in contango. That's a fancy word for a simple idea. Future delivery costs a bit more than right now delivery because you have to store the metal, insure it, finance it, and tie up balance sheet. In a calm market, that upward slope is steady and rational. But when the market tightens, or when demand gets urgent, that calm slope can flatten. It can even flirt with backwardation, where near-term metal is effectively priced more dearly than future metal. In plain language, someone is willing to pay to get it now, not later. And the reason that matters this week isn't academic, because dealers hedge their inventories, refiners plan throughput, and funds roll positions based on that slope. If the slope changes, behavior changes. Not might, will. And when behavior changes, price discovery changes. But that's not the part that matters most. The part that matters most is what it forces participants to do when the market turns from a price story into a delivery story. Think about it like this. If you're a dealer or a big player running inventory, you're constantly balancing three things: price risk, financing cost, and the ability to source or deliver. When carry behaves normally, you can warehouse exposure. When carry tightens, you get punished for holding the wrong thing at the wrong time. And when carry tightens enough, it can create the kind of paper versus physical tension that makes people say silly things like, the price is manipulated. You don't need a conspiracy to explain most of it. You need incentives. You need balance sheet constraints. You need risk managers telling desks to reduce exposure into volatility. You need the reality that a market can be liquid until it isn't. And once it isn't, the move accelerates. And that's when everyone starts pretending they always knew it would happen. Now, why now? Why does this feel like it's shifting fast this week and this month, not sometime later? Because we're sitting right in a forced move window on the calendar. You've got major macro data risk, especially around the US jobs print and the market's obsession with what it implies for rates. You've got early year allocation behavior, fresh budgets, fresh mandates, fresh rebalancing decisions. And layered on top of that, you've got commodity index mechanics and institutional reweights that can create real buying or selling pressure that has nothing to do with whether a commentator feels bullish. These aren't vibes, these are flows. And flows don't argue with your narrative. They execute. And if you want to understand why metals can feel like they're teleporting, you have to respect the calendar triggers that force funds to act, even when they'd prefer to wait. And the next detail is what flips the whole setup. Because the popular story is still stuck in a stale loop. Gold is up because inflation, or gold is up because geopolitics, or gold is up because the dollar is down. Sometimes those are partially true, but they're not sufficient. The deeper driver is the macro regime pressure, the path of real rates, the dollar's reflex around growth and inflation expectations, and the volatility bands that risk managers use to decide how much exposure is allowed. Here's why that matters. If rates are expected to fall, or even if the market just believes the peak in restrictiveness is behind us, gold becomes less expensive to hold relative to cash. That's opportunity cost. But on top of that, when real rates become unstable, gold becomes a cleaner hedge because it's not tied to a single corporate balance sheet. And when currency stress shows up in pockets, when confidence in the system feels less certain, gold gets pulled into the conversation not as a trade, but as a reserve asset. That's a different kind of demand. It's not emotional retail buying. It's strategic positioning. And strategic positioning doesn't sell because a chart looks overbought. It sells because policy or risk changes, and you can see that in how serious institutions are talking. When you hear credible desks discussing wide ranges, like gold potentially living anywhere from the high 3,000s to north of $5,000 within a year, it isn't a guarantee. It's an admission. It's them saying volatility is the regime. And that changes everything, because in a volatility regime, the best players don't try to predict every wiggle. They build a framework, levels, triggers, invalidations, and optionality. And that's where you win too, not by guessing, but by refusing to get emotionally dragged around by the tape. But before we get to the psychological shield, there's one more proof layer you need, because it explains why dips can get absorbed faster than skeptics expect. Central bank behavior. This matters because it's one of the least sentimental sources of demand in the entire market. Central banks don't buy because gold is trending on social media. They buy because they're diversifying reserves, reducing reliance on a single currency system, managing geopolitical risk, or responding to domestic monetary realities. And when that demand is present, even if it's not constant every day, it changes the character of the market. It can create a bid that doesn't disappear on the first red candle. It can create a floor that feels invisible until it's tested. And it can make the market feel like it's refusing to go down, which is exactly when weak hands get baited into chasing late. And that's where people get hurt. But that's not the part that matters most. The part that matters most is how the market's inventory optics can mislead you right when you need clarity. Because you're going to hear people say things like, there's plenty of metal in vaults. And they'll cite big tonnage numbers. And yes, if you look at London vault holdings, you can see thousands of tons of gold and tens of thousands of tons of silver sitting in the system. But here's the mechanic the public almost always misses. Stored metal is not the same as deliverable metal. Held metal is not the same as available float. Some inventory is allocated to someone who isn't selling. Some is earmarked for ETFs. Some is pledged. Some is part of a chain of financing that makes it functionally untouchable at the exact moment stress rises. So the correct question isn't how much exists. The correct question is how much can move at the price without creating a problem. All right. And when that answer tightens, the market stops behaving politely. And this is where silver in particular becomes dangerous in both directions. Silver is not just gold's little brother. Silver is a hybrid, monetary narrative on one side, industrial reality on the other. And the industrial side isn't optional. It's procurement, it's manufacturing, it's supply chains. It's components that can't be swapped out easily without redesign, testing, and time. And when industrial demand tightens, especially in sectors that are sensitive to electrification, solar, electronics, and broad manufacturing cycles, you get a bid that can become price insensitive in the short term. Not forever, but long enough to create squeezes that feel unreal. Meanwhile, supply isn't as elastic as people assume. A lot of silver supply is byproduct. It comes out of mining for other metals. You can't just turn on a silver mine because the price went up. Lead times are real. Permitting is real. Refining constraints are real. Recycling helps, but it doesn't magically fill a structural deficit overnight. So if you combine persistent deficit narratives with industrial procurement urgency, you get exactly the kind of market that can lunge higher and then whip back violently, all while being structurally tight underneath. And that is how you get trapped if you treat it like a calm stock chart. Because if this one level breaks, the math changes. Now add one more layer that the mainstream barely mentions because it's messy: trade friction and policy constraints. When key industrial inputs face licensing requirements, export controls, or shifting trade rules, procurement departments behave differently. They front load. They build buffer inventory. They become less willing to run lean. and when enough large buyers decide we can't risk being short inventory. That is demand that shows up before the headlines. It shows up in tightness, in premiums, in lead times, in the kind of subtle stress signals you won't see on a simple chart. And this circles us right back to the hidden detail. China paying up more aggressively than India tells you demand isn't uniformly collapsing under high prices. It's rotating into pockets where the motivation isn't jewelry and celebration. It's strategy, policy, and reserve behavior. And that is a different beast. But let's get brutally practical, because this is where people either build trust with reality or they get farmed by volatility. When metals move like this, market structure takes over. Positioning matters. Leverage matters. Margin matters. And the most violent moves usually have at least one forced ingredient. Short covering, dealer hedging, or both. Here's short covering in plain language. If you're short and the market moves against you, your broker or clearinghouse doesn't care about your thesis. They care about risk, they raise margin requirements, or you hit your own risk limit. You are forced to buy back. That buying is not discretionary. It's not smart money deciding to reverse. It's a mechanical bid that hits when the market is already moving up, which accelerates the move. Silver is especially prone to this because it's smaller, it's more volatile, and it attracts the kind of positioning that looks fine until it isn't. And when it isn't, liquidity thins and price jumps. But that's not the part that matters. The part that matters is how you can tell whether a move is still healthy or whether it's turning into a squeeze that can punish you even if you're directionally right. That's where the two-scenario lens comes in. It's the simplest discipline that keeps you from being emotionally manipulated. Scenario 1 is the controlled pullback and retest. In this scenario, gold consolidates around the mid-4400s, dips toward a clear support zone, and then stabilizes. Silver cools off from the high 70s, maybe revisits the low to mid-70s, and finds buyers without panic. You'll see volatility, yes, but it will look like digestion. Lower highs, higher lows, churn, then resolution. In this scenario, the bullish thesis stays alive because dips are bought in an orderly way, premiums don't collapse, and the market structure doesn't show panic liquidation. This is where patience beats adrenaline. Scenario 2 is the continuation squeeze. In this scenario, there is no polite pullback. There are gaps, there are fast candles. Gold pushes back toward its record area around the mid-$4,500 and tests whether the market can accept those prices as the new normal. Silver threatens the prior extremes people still remember, levels in the 80s that act like a magnet and a trap at the same time. In this scenario, the risk isn't just being wrong. The risk is gap risk and whipsaw risk, getting stopped out in both directions because the market is moving too fast for your emotions to keep up. And this is where most people lose money even if they guess the direction, because the market doesn't just move. It weaponizes volatility. So what confirms each scenario? You don't need a crystal ball. You need a checklist. First, watch the physical premium story. If China stays willing to pay a large premium over spot while other regions soften, that tells you the marginal demand is strategic and urgent, not purely price sensitive. If those premiums suddenly compress across the board, that's a warning that the physical bid is cooling. Second, watch the cost of carry and the curve behavior. If near-term tightness shows up, flattening carry, elevated urgency for prompt delivery, that's supportive of a real move. If carry normalizes while price chops, it suggests the market is drifting back into a more financialized, less stressed state. Third, watch the dollar and real rate impulse around key data. You don't need to be a macroeconomist, just notice the reflex. If gold refuses to break down even when the dollar firms and data prints hot, that's strength. If gold dumps hard on a routine dollar bounce, that's fragility. Fourth, watch the way price reacts at obvious reference levels. For gold, the mid-4,400s is a psychological and structural region right now. If it holds and rebounds, buyers are defending. If it slices through and can't reclaim, the market is telling you the dip bid is weaker than it looked. For silver, the high 70s versus the low to mid 70s is the same story. Can it hold a higher base, or does it revert hard? Fifth, watch institutional tone shifts, not the loudest influencer, the serious desks. When credible research starts widening ranges and emphasizing volatility rather than one way up, that's not bearish. It's a signal that risk is rising, which can actually support the market if positioning remains disciplined. But if the same voices begin walking back their constructive stance rapidly, it often coincides with positioning stress. Sixth, watch on-the-ground symptoms, retail availability, fabrication demand signals, and any anecdotal tightening in supply chains. You don't need perfect data, you need consistent clues. In stressed markets, the symptoms become visible even before the charts make sense. Now, let's address the counterpoints, because credibility demands it, and because the market will punish you if you ignore them. High prices do crush certain kinds of demand. Jewelry demand can soften. Price-sensitive consumers step back. India a softer premium environment is not irrelevant. It is the market telling you there as resistance. And on top of that, when a market has run this far, this fast, mean reversion is always a threat. Even if the long-term thesis is intact, the short-term path can be brutal. You can get a 5% move that feels like the end of the world and then the trend resumes. Or you can get a break that looks like a dip and then turns into a deeper correction. Both happen. This is why you need invalidation levels and why you need to respect volatility. Because if you don't, the market will use your emotions against you. And that brings us to the viewer psychology shield, the part that keeps you from getting played. Here's how the tape manipulates you, even without any villain in the room. First, it seduces you with certainty after a big move. It makes you feel like you finally get it. Then it snaps back violently, right when your confidence is highest. That snap triggers panic. Panic forces you to sell at the worst time or chase at the worst time. Then the market stabilizes and you're left with regret. That's the loop. And the only way out is to decide in advance what is trend signal and what is noise. Trend signal is higher lows holding, key support zones respected, physical signals not collapsing, macro regime supportive, and pullbacks being absorbed rather than accelerating. Noise is intraday spikes, headline whiplash, one-off comments, and the emotional urge to do something because a candle is large. Professionals expect whipsaws. They plan for them. Retail often takes them personally. Don't. The market is not judging you. It's testing your process. So here's the discipline that matters this week. You don't need to predict the exact top. You need to refuse to be shaken out of a thesis by normal volatility, while also refusing to marry a thesis when the invalidation triggers. That sounds simple, but it's rare. The market rewards rare behavior. And that's why I'm giving you the framework. 2 scenarios, clear levels, and a checklist rooted in mechanics, not vibes. Now, let's talk about what comes next, specifically in the next week or two, because this is where the payoff is. If we get the controlled pullback and retest, expect the market to spend time, not days, time. You'll see churn, you'll see fake breaks. You'll see headlines that explain every wiggle. Ignore the noise and watch the reactions. Gold holding that mid-4400s neighborhood and finding buyers on dips would be a constructive signal, especially if physical premiums remain elevated in key regions and the curve doesn't relax too much. Silver holding a higher base, rather than collapsing back into the old range, would suggest the market is repricing its equilibrium. If we get the continuation squeeze, respect the possibility of gaps. This is where you can see sudden pushes toward the recent highs again, gold challenging the mid-4500s record region, silver threatening the 80s. And in this scenario, the thing that will tell you whether it's sustainable is not the size of the candle. It's what happens after the candle. Do we hold gains? Do premiums stay firm? Does the curve stay tight? Do dips get bought instantly? Or do we see the classic pattern of exhaustion? Big spike, immediate fade, and inability to reclaim? That's the tell. Because that one pattern, fail to reclaim, often marks the shift from continuation to correction. And that's where the real pressure starts. Now let me give you the practical what invalidates this level concept. Without pretending we can see the future, invalidation is not, I feel uncomfortable. Invalidation is a behavioral change. For gold, if we lose a key support zone and fail to reclaim it on a retest, that's not just a red day. That's the market saying the bid is weaker. For silver, if the market can't hold a higher base and starts slicing through supports with accelerating volume and collapsing physical signals, the character changes. You don't need perfect numbers. You need to recognize character shifts. And the fastest way to recognize them is to stop obsessing over the spot price alone and start watching the supporting cast. Premiums, carry, macro impulse, and positioning stress. One more thing, because it matters a lot in markets like this. Volatility will be used against you, not by a person, by the structure. When volatility rises, margin requirements rise. When margin requirements rise, forced selling can appear out of nowhere. That forced selling can create temporary air pockets, even in bullish regimes. Then the market snaps back, and it feels unfair. It's not unfair. It's the cost of playing in a leveraged ecosystem. And the way you protect yourself is not by seeking certainty. It's by keeping your time horizon consistent and refusing to oversize your exposure. You can be bullish and still respect that price can whip around violently, even if the thesis is correct. That sentence alone saves portfolios. Now, zoom out for a second and let's connect the proof stack so you can see the whole picture, not a single argument. You've got price context showing strength and new highs. You've got a hidden physical signal showing regional divergence. China paying up, India softer, telling you demand is rotating, not simply disappearing. You've got term structure mechanics that can reveal whether the market is pricing urgency. You've got institutional range language signaling a volatility regime. You've got central bank demand operating as a non-sentimental bid. You've got vault holdings that look large, but can be misleading because deliverable float is what matters. You've got silver's industrial pull and structural supply constraints, including byproduct supply realities and policy frictions. And you've got positioning and margin mechanics that can turn a move into a lunge. That's not one argument, that's 6 layers. And when 6 layers point in the same direction, you don't need certainty. You need a plan. So here's my base case, stated cleanly. The metals complex is in a fast shifting phase where internal signals matter more than headlines. The most likely path is continued volatility with bullish pressure as long as physical tightness signals remain credible and the macro regime doesn't shock the market into a sustained, higher for longer repricing. But within that base case, you must respect the 2 scenarios, controlled pullback and retest versus continuation squeeze. And you must treat both as plausible, because pretending one is guaranteed is how you get emotionally cornered. And now the concrete payoff I promised at the start, the next week checklist. If you do nothing else, watch these 4 things. 1. China versus India premiums. Do they stay split, tighten, or reverse? 2. The curve. Does carry stay tight, or does it relax as price turns? 3. The dollar and real rate impulse around data. Does gold hold up even when the macro tape tries to push it down? 4. Price reaction at the obvious reference levels. Does gold defend the mid $4,400 neighborhood, and does silver hold a higher base in the 70s without collapsing? If those 4 stay supportive, the path of least resistance remains higher, even if it's messy. If 2 or more flip against you, especially the physical signals and the reclaim behavior, the market is telling you risk has changed and you should respect that. And here's the subtle CTA, because I'm not interested in building a crowd of people who chase candles and disappear on red days. If you're the kind of investor who wants mechanisms over narratives, who would rather understand what forces participants to act than argue about whether someone is bullish, then you're in the right room. Stay sharp, stay disciplined, and let the spreads, the carry, and the physical signals tell you the truth. Because the headline price will lie to you right when it matters most, and the next detail is what flips the whole setup.